Have you ever wondered why so many traders fail, despite having access to the same information, the same charts, and the same opportunities as those who succeed? What if I told you there's one fundamental principle that separates the winners from the losers in this game, and it has nothing to do with having the perfect strategy or finding that one magical trade? But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Now, let's talk about what Richard Wyckoff, one of the greatest market operators of all time, called the rule of consistency, the single most powerful concept that can transform your trading results forever. Has this ever happened to you? You make a solid profit on a trade, only to give it all back the very next week because you abandoned your rules. You're not alone. The markets can be brutal and unforgiving. They have no memory of your past successes or failures, but your trading account certainly does. Every dollar you lose becomes a debt that must be repaid, and the climb back to break even is far steeper than most realize. Think about this. A 20% loss in your account requires a 25% gain just to get back to where you started. At 50% down, you need a 100% gain, double your money, just to break even. Stay with me until the end, because understanding this mathematical reality of trading losses is essential to your survival in the markets. This isn't just theory, it's the cold, hard arithmetic that governs whether you'll still be in this game a year from now. What many traders fail to grasp is that without consistency, you're not a trader at all. You're simply a gambler throwing coins into the wind and hoping one lands heads up. The market doesn't reward occasional brilliance. It rewards methodical, disciplined execution day after day, week after week. Wyckoff understood that the greatest edge in trading isn't found in some secret indicator or pattern. It's found in your ability to remain consistent when everyone else is breaking their rules. What you're about to discover might surprise you because it goes against much of what's promoted in trading circles today. The consistent trader builds their account slowly but surely, like constructing a fortress brick by brick. They cut losses quickly and let winners run, not because they're hoping for the best, but because they've made an unbreakable commitment to a set of principles that guide every decision. But how exactly do you develop this consistency when the markets are constantly testing your resolve? What specific habits separate the consistent operator from the inconsistent gambler? And why do even experienced traders fall into the trap of breaking their own rules at the worst possible moments? The transformation begins when you understand that consistency isn't something you achieve overnight. It's the result of building unwavering habits that become second nature. These habits form the foundation of your trading mindset, much like the disciplined routine of an elite athlete. You see, Richard Wyckoff observed that the most successful operators in the market followed their rules with the same dedication that soldiers follow orders. There was no room for negotiation, no space for exceptions. Think about what this means in practical terms. If you've established a rule to never add to a losing position, then you never add to a losing position. Not when you're certain the market is about to turn. Not when the stock seems too cheap to ignore. Not even when your favorite guru is pounding the table saying to buy more. The moment you make that one exception, you've opened the door to a dangerous pattern of inconsistency. The market has an uncanny ability to detect and punish those who bend their own rules. It's almost as if it's designed to test your resolve, to see if you're serious about your commitment to consistency. And the moment you falter, that's when it delivers its harshest lessons. This journey toward trading mastery reveals a crucial distinction between good traders and truly great ones. Both will experience winning and losing trades. That's simply the nature of the game. Even Wyckoff himself, with all his experience and market wisdom, took his share of losses. The hidden truth that separates the elite from everyone else isn't found in their win rate or their ability to predict market moves. What distinguishes great traders is their unwavering commitment to keeping losses small and their methods steady. When they take a hit, and they all do, it's a controlled, anticipated event that barely impacts their overall performance. They've accepted losses as part of the process, not as failures to be avoided at all costs. Their impact on the market comes from this profound acceptance. Meanwhile, inconsistent traders reveal themselves by how they handle adversity. They allow a single loss to balloon into a catastrophe. They move stop-loss orders to avoid taking a small hit, only to watch in horror as that position turns into a major drawdown. They abandon their system after a string of small losses, switching to something new just before their original approach would have delivered excellent returns. Now, I want to go even deeper into this topic by exploring how consistency protects you from your worst enemy in trading, yourself. Because let's be honest, the decisions that derail our trading journey rarely come from market forces alone. They come from our emotional reactions to those forces, from our tendency to second-guess ourselves at precisely the wrong moment. When you establish clear rules and follow them without exception, you create a buffer between your emotions and your actions. This buffer doesn't eliminate fear or greed. Those emotions are hardwired into our brains, but it does prevent them from hijacking your decision-making process. In essence, consistency becomes your personal shield against the psychological warfare that is the stock market. If you've experienced this moment of clarity where you realized your trading rules saved you from a potential disaster, write in the comments, "My rules protected me." I'd love to hear your personal stories of when consistency made all the difference in your trading. The revelation that transforms average traders into consistent professionals is understanding that consistency extends far beyond just your entries and exits. It encompasses your entire philosophy toward capital management. Think about it. How do you view the money in your trading account? Is it just numbers on a screen, a plaything to be risked on exciting opportunities, or something more sacred? Wyckoff had a profound perspective on this. He viewed every dollar in his trading account as a disciplined soldier in his army. Each one had a specific purpose, a role to play in the larger battle. When you adopt this mindset, the very nature of your relationship with money undergoes a fundamental shift. You stop seeing your capital as something to gamble with and start seeing it as something to protect, nurture, and deploy strategically. Behind the scenes of every successful trader's journey is this same reverence for capital. They don't send their soldiers into battle without proper reconnaissance, without understanding the terrain, without knowing exactly when to advance and when to retreat. When you treat your trading capital with this level of respect, it responds by working for you day after day, compounding over time into something truly remarkable. Consider the alternative, the casual trader who treats their account like casino chips. They may experience occasional victories, but the market has an uncanny ability to sense this disrespect for capital. And sooner or later, it takes everything back with interest. This isn't just about money. It's about honoring the principles that govern success in any endeavor. The heartbreaking reality is that most failed traders don't start out intending to fail. They begin with solid plans and good intentions. They've read the books, studied the charts, and created detailed trading systems. But their downfall comes from a single, devastating habit: abandoning their rules when faced with adversity. It's a pattern I've witnessed countless times. The market throws a curveball, perhaps an unexpected news event or a sudden reversal in trend. Instead of adhering to their predetermined rules, they panic. They double down on losing positions when their system clearly tells them to cut losses. They chase runaway stocks when their rules say to wait for pullbacks. They let raw emotions dictate their decisions rather than the cold, rational methods they've developed. This emotional hijacking represents the greatest threat to your trading success. It's the moment when your amygdala, the primitive fear center of your brain, overrides your prefrontal cortex, the seat of logical decision-making. And in those moments, years of knowledge and careful planning can be undone in seconds. The irony is that the market's curveballs aren't random tests. They're inevitable challenges that every trader must face. The consistent operator doesn't try to avoid these moments. They prepare for them by establishing unbreakable rules beforehand. They create systems that account for their own human weaknesses and emotional vulnerabilities. Let me ask you something deeply personal. Have you ever found yourself abandoning your trading rules in the heat of the moment, only to regret it afterward? That moment of awareness, painful as it might be, represents the first step toward real transformation. It's the recognition that consistency isn't just a trading strategy, it's a way of being. Now I want to examine something equally crucial: how consistency applies to how you interpret market information itself. Because even the most disciplined trader can be led astray if they're inconsistent in how they read the signals the market provides. If you've ever promised yourself never again, after breaking your own trading rules, drop a comment saying, "Rules are non-negotiable, so we can acknowledge this crucial commitment together." One of the most profound revelations in any trader's journey comes when they truly understand what charts represent. Charts aren't crystal balls meant for prediction. They're mirrors reflecting the actual behavior of market participants. They tell you what is happening, not what you hope will happen. This distinction may seem subtle, but it represents a fundamental shift in perspective that separates consistent operators from everyone else. The consistent trader approaches charts with reverence, reading them like a master reading an ancient text. They understand that each price, each volume spike, each pattern forming on the screen is telling a story that's still unfolding. They don't impose their narrative onto the chart. Instead, they let the market reveal its intentions page by page. This patience, this willingness to wait for confirmation before acting, becomes their greatest asset. In contrast, the inconsistent trader falls into the trap of prediction. They look at a chart and immediately try to guess the ending of a story that's still being written. They force their biases, hopes, and fears onto the price action, seeing patterns that aren't there and ignoring signals that contradict their predetermined views. It's like reading the first chapter of a mystery novel and declaring you know who the killer is. You might be right occasionally, but you'll be wrong far more often. The hidden truth here is that respecting charts isn't about having some mystical ability to predict the future. It's about humility, acknowledging that the market is larger than any individual and that our job is to align ourselves with its rhythm rather than fighting against it. When you embrace this humility, trading becomes less about being right and more about being in harmony with what is actually happening. Now, here's where many traders encounter a dangerous obstacle on their path to consistency. They confuse consistency with stubbornness, a misunderstanding that can devastate their accounts. Let me be crystal clear. These are completely different mindsets with opposite outcomes. A stubborn trader clings to losing positions because they can't bear to admit they're wrong. They ignore breaking trend lines, deteriorating fundamentals, and their own stop-loss levels because they've become emotionally attached to their thesis. The market just doesn't understand yet, they tell themselves. It will come back. This psychological defense mechanism might preserve their ego temporarily, but it destroys their capital permanently. The consistent trader, by contrast, understands that being wrong is an inevitable part of the game. When a position violates their predetermined rules, they exit immediately. Not because they're happy about taking a loss, but because they respect their system more than they fear being wrong. They recognize the psychological watershed moment when a trade breaks their rules and act decisively without hesitation or regret. This subtle distinction represents one of the most crucial crossroads in a trader's development. One path leads to survival and eventual prosperity. The other leads to mounting losses and frustration. The choice seems obvious when discussed rationally, yet in the heat of battle with real money on the line, many choose stubbornness over consistency. The remarkable thing about this realization is how it transforms your relationship with being wrong. Instead of viewing losses as failures, you begin to see them as valuable data points, information that helps you refine your approach and grow stronger. This perspective shift doesn't happen overnight, but when it does, it changes everything about how you trade. Let's examine another dimension of consistency that few traders talk about: how it actually saves you from the exhaustion of constant decision-making in chaotic market conditions. If you've ever confused stubbornness with consistency and held on to a losing trade much longer than you should have, type "I've learned my lesson" in the comments. There's power in acknowledging these moments of growth. The battlefield of trading isn't just on your screen, it's in your mind. One of the most enlightening discoveries on this journey is understanding that consistency serves as a psychological shield against your own emotional impulses. You see, fear and greed, the twin demons of trading, never truly disappear, no matter how experienced you become. They simply become more sophisticated, finding new disguises to infiltrate your decision-making process. Fear might initially show up as the obvious panic when a position moves against you, but as you evolve, it transforms into subtle rationalizations. "This time is different," or "I need to give this trade more room." Similarly, greed begins as simple excitement over profits, but later disguises itself as strategic position building or maximizing opportunity. The enlightenment comes when you recognize these emotions not as enemies to be conquered, but as permanent residents of your trading psychology that must be managed. This revelation leads to a profound mindset shift. You stop trying to eliminate emotions, an impossible task, and instead create a methodology that functions regardless of how you feel. The consistent trader doesn't fight fear with courage. They neutralize it with process. When your rules state that you exit a position when it breaks support, you exit, regardless of the knot in your stomach or the voice whispering just a little longer. Behind the scenes of every successful trader's career is this same battle, not with the market, but with themselves. The market is merely the arena. The real opponent is the trader's own psychological vulnerabilities. When you establish consistent rules and follow them religiously, you're essentially creating a barrier between your emotional impulses and your trading actions. This buffer zone is where rational decisions can survive even in the storm of market volatility. Now, let's examine the practical mechanics of what consistency actually looks like in daily trading operations. The transformation begins with specific, non-negotiable decisions made before you ever place a trade. Consistency means determining exactly how much capital you'll risk on any single position, perhaps 1% or 2% of your account, and never exceeding that amount, regardless of how certain you feel about the opportunity. It means setting your stop-loss orders at the precise moment you enter a trade, not as an afterthought, and never moving those stops further away from your entry point. This discipline protects you from the devastating impact of allowing small losses to become account killers. The professional trader understands that each individual trade is merely one of thousands they'll make over their career, and no single trade is worth compromising their system. Consistency also means defining specific setups and patterns that you'll trade, your edge in the market, and having the discipline to ignore everything else. The market presents endless opportunities every day, but the consistent trader waits patiently for their specific conditions to align. They don't bend their rules because they're bored or excited. They recognize that impatience is just another form of emotional interference. What's remarkable about this approach is how it liberates you from the exhaustion of constant decision-making. When your rules are clear and non-negotiable, trading becomes less stressful and more methodical. You're no longer wrestling with each decision, wondering if you should take this trade or pass, move your stop or hold firm. The decisions have already been made through your system, freeing your mental energy for observation rather than agonizing deliberation. Let's explore how consistency creates another powerful advantage that few traders recognize: the ability to accurately measure your performance and refine your approach over time. If you've established clear trading rules that help shield you from emotional decisions, write "My system is my shield" in the comments. I'm curious how many of you have discovered this powerful truth for yourselves. There's a hidden principle at work in consistent trading that mirrors one of the most powerful forces in finance: compound interest. Just as money compounds over time when interest is reinvested, the effects of consistency compound in your trading account through a similar mechanism. One consistent decision, cutting a loss quickly, letting a winner run, waiting patiently for the right setup, might seem insignificant in isolation. The immediate impact on your account might be small, perhaps just saving you a few percentage points of drawdown or capturing a bit more profit. But this is where the magic unfolds. When you stack these small, consistent decisions day after day, week after week, and month after month, the cumulative effect becomes nothing short of transformative. It's similar to building a wall brick by brick. The first few rows don't offer much protection, but keep laying those bricks consistently, and eventually you have an impenetrable fortress protecting your capital. Richard Wyckoff observed this phenomenon throughout his career. He watched as flashy traders made spectacular gains and equally spectacular losses, while the consistent operators quietly built substantial fortunes through the methodical application of sound principles. The revelation here isn't about finding some secret trading strategy that delivers overnight riches. It's about embracing the power of small, consistent actions repeated over time. This compounding effect operates in multiple dimensions of your trading. Your capital compounds as you consistently protect it and grow it. Your knowledge compounds as you consistently learn from each trade. Your psychological strength compounds as you consistently face challenges and overcome them. Before you know it, you've created something remarkable. Not through a single brilliant move, but through unwavering commitment to your process. Now, I want to go even deeper into this topic by exploring perhaps the most valuable asset consistency builds: genuine self-trust. This journey toward trading mastery eventually leads to a profound internal shift. When you follow your rules day after day, something extraordinary happens. You begin to trust yourself, not the fleeting confidence that comes after a winning streak, but a deep, unshakable faith in your ability to navigate whatever the market throws at you. This self-trust becomes your most precious resource when market storms arrive, and they always do. When volatility spikes, when correlations break down, when panic grips other traders, the consistent operator has a remarkable advantage. While others freeze in uncertainty or react emotionally to chaos, the trader who trusts themselves acts with clarity and purpose. They don't need to second-guess their decisions because they've proven to themselves, through consistent action, that their system works over time. The behind-the-scenes reality of great traders is that they've all faced moments of extreme market stress, flash crashes, limit downs, geopolitical shocks. But what separates them is their response in those moments. The consistent trader who has earned their own trust doesn't abandon their principles under pressure. Instead, they lean into them more firmly, knowing that their consistent approach is precisely what will see them through the turbulence. This self-trust creates a positive feedback loop. The more consistently you follow your rules, the more you trust yourself. The more you trust yourself, the easier it becomes to follow your rules, even in challenging conditions. This virtuous cycle accelerates your development as a trader in ways that searching for the perfect indicator or setup never could. Let's examine how consistency helps you develop another crucial quality that most traders struggle with: the patience to wait for ideal opportunities rather than forcing trades out of boredom or FOMO. If you've experienced that moment when your consistency helped you trust yourself during market chaos, share "Self-trust saved me" in the comments. These moments of clarity amid market storms often define our trading journeys. One of the most valuable gifts consistency bestows on a trader is something increasingly rare in our fast-paced world: genuine patience. In the modern trading environment, where action is constantly available and markets never truly close, the ability to wait has become a superpower. Yet most traders struggle tremendously with this discipline, constantly feeling the urge to be in the market, to be doing something, anything, rather than sitting on their hands. The transformation occurs when you embrace consistency in your approach. Suddenly, patience isn't something you need to force. It flows naturally from your commitment to your process. The consistent trader understands a profound truth that Wyckoff observed decades ago. Waiting is often the most powerful position you can take. They recognize that the market presents only a limited number of truly favorable opportunities that meet their specific criteria. Everything else is just noise. This revelation changes your entire relationship with the market. Instead of seeing trading as a constant activity requiring your participation at all times, you begin to view it as a selective engagement only when conditions align perfectly with your edge. The space between trades, what many consider downtime, becomes something you value rather than something you avoid. It's in these quiet moments of observation that your understanding deepens and your ability to recognize ideal setups sharpens. The journey toward this patient mindset isn't easy. Our brains are wired for action and stimulation. The dopamine hit that comes from placing a trade creates a powerful temptation, especially during periods when the market isn't presenting your specific setups. The consistent trader acknowledges this psychological reality, but overcomes it through unwavering commitment to their rules. They decide in advance what conditions must be present before they engage, and they simply don't trade until those conditions materialize. When the perfect setup finally appears, when all their criteria align, they act decisively and with conviction. There's no hesitation, no second guessing, because they've trained themselves to recognize exactly what they're looking for. This balance between patient waiting and decisive action represents trading mastery at its finest. Now, I want to go even deeper into this topic by exploring a critical tool that reinforces consistency: meticulous record keeping. Behind every successful trader's screen is a detailed journal documenting their journey. This isn't just about tracking profits and losses. It's about creating a feedback loop that strengthens your consistency over time. The consistent trader records everything, not just what they traded, but why they traded it. What they were thinking at the time, what their expectations were, and what actually happened. They document their emotional state, their level of conviction, and any deviations from their rules. This practice might seem tedious, but it reveals patterns that would otherwise remain invisible. Over time, these records become a treasure trove of insights. You might discover that you consistently perform better in trending markets than in choppy ones. You might notice that your morning trades outperform your afternoon ones. You might identify specific setups that yield higher win rates or better risk-reward ratios for your particular style. Without detailed records, these patterns remain hidden, and your ability to refine your approach is severely limited. This documentation process also serves as an accountability mechanism. It's much harder to break your rules when you know you'll have to write down exactly why you did it. The simple act of recording your decisions creates a powerful incentive to remain consistent even when emotions are running high. Let's explore how consistency helps you overcome another major obstacle that derails countless trading careers. The destructive habit of overtrading that slowly bleeds accounts dry through death by 1,000 cuts. If you've experienced that moment of clarity when your trading journal revealed a pattern you hadn't noticed before, share. My journal showed me the way in the comments. These personal discoveries often mark turning points in our development as traders. One of the most illuminating realizations on this trading journey is how consistency serves as a natural antidote to one of the most destructive habits that plague traders: overtrading. This affliction has ended more trading careers than perhaps any other single factor. It's the disease of the impatient and the greedy, those who feel compelled to always be in the market, always chasing the next move, always looking for action. The symptoms are easy to spot but difficult to overcome without a foundation of consistency. The overtrader jumps from stock to stock, never allowing a position enough time to develop. They switch methods constantly, abandoning approaches at the first sign of difficulty and chasing whatever seems to be working at the moment. They're perpetually busy but rarely profitable, like someone running on a hamster wheel, lots of motion, no progress. The awakening comes when you recognize that consistent trading often means doing less, not more. The disciplined trader understands their edge with crystal clarity and waits patiently for specific setups that meet all their criteria, not just some. They ignore everything else, no matter how tempting it might appear. This selectivity might result in fewer trades, but each one carries a higher probability of success and a better risk-reward profile. This revelation transforms your relationship with activity itself. In a culture that often equates busyness with productivity, the consistent trader embraces the counterintuitive truth that sometimes the most profitable position is no position at all. They understand that conservation of capital during unfavorable conditions is just as important as deployment of capital when opportunities arise. The watershed moment in many traders' journeys comes when they finally accept that it's not how many trades you make that determines success. It's the quality of those trades and how well they align with your proven edge. The consistent trader might make only a fraction of the trades that an overtrader makes, but their equity curve tells the real story: steady growth punctuated by occasional drawdowns, rather than the wild swings and eventual decline that characterize the overtrader's account. Now, I want to go even deeper into this topic by exploring what might be the most profound metaphor Wyckoff ever shared about trading. The concept that every dollar in your account is like a soldier in your army. This powerful visualization changes everything about how you approach the markets. Think about what this really means. In warfare, no competent general would send troops into battle without a clear strategy, without understanding the terrain, without proper intelligence about the enemy's position. Yet traders routinely deploy their capital, their soldiers, into the market battlefield with nothing more than a hunch, a hot tip, or an emotional reaction to price movement. The consistent trader adopts the mindset of a disciplined field commander. They recognize that each dollar represents potential power, but only if deployed strategically and protected carefully. They never send their capital into situations where the odds don't strongly favor success. They establish clear parameters for engagement and withdrawal. They respect the reality that an army without discipline gets slaughtered, regardless of its size. This military perspective illuminates why consistency matters so much. The market battlefield is unforgiving, constantly changing, and filled with uncertainties. The only thing you truly control is how and when you deploy your forces. Your consistency in following sound principles becomes the armor that protects your capital from reckless destruction. Let's examine how consistency creates one more crucial advantage: the ability to maintain emotional equilibrium during the inevitable streaks of both winning and losing trades that all traders experience. If the metaphor of treating your trading capital like soldiers in an army resonates with you, comment, "My capital deserves respect," below. This mindset shift often marks the transition from gambling to professional trading. As we've explored Richard Wyckoff's timeless wisdom on consistency, I hope you've recognized parts of your own trading journey in these principles. The path to trading mastery isn't found in some secret indicator or undiscovered pattern. It's built through the daily discipline of following your rules without exception, treating your capital with the respect it deserves, and trusting the process even when it feels uncomfortable. Remember, consistency isn't glamorous. It won't make headlines or impress people at parties, but it will do something far more valuable. It will keep you in this game long enough to succeed when most others have blown up their accounts and walked away. It will transform trading from a series of emotional reactions into a methodical business that compounds your edge over time. If you found value in these insights today, consider becoming part of our trading community by hitting that subscribe button. I share these kinds of psychological trading truths every week, the kind that took me years of painful lessons to discover. Your subscription tells me these deeper trading concepts matter to you. If this message on consistency resonated with something you've been struggling with in your own trading, drop a comment saying, "Consistency is my edge," so I know you made it to the end. Your comments help me understand which topics truly connect with serious traders. And if you found this valuable, a simple like helps other traders discover these concepts too. It's how we build a community of consistent, disciplined market participants who approach this business the right way. There's a video right here about how to develop your own trading rules that pairs perfectly with today's topic. Click and continue with me over there as we build on these consistency principles with practical steps for creating rules that truly protect your capital. Until next time, remember, in the world of trading, consistency isn't just a virtue, it's survival.